Mickey Dickey here, and I wanted to discuss what happened with Jackson Hole last week and what Powell actually said. Now, I've got several videos I want to go through and give you my opinion on because, again, it just seems to be really all over the board, and I think people have really missed the nuts and bolts of what happened at Jackson Hole. So let's start with this one.
Let's get to it with Mohammed to talk about the markets. Big week of economic data coming up and the feeling coming out of Fed Chair Jay Powell's Jackson Hole speech, Mohammed. And first of all, welcome and good to see you. What's your main takeaway? A year after Powell was brief and relatively blunt and harsh and trying to persuade the markets that a lot more tightening was to come, he seemed not really to want to make explicit news. He recapitulated the current situation. Inflation's down a lot, but not enough. We may hike more, but we're going to be data dependent. Not talking about cuts just yet. Where does that leave us?
So first, what Powell did, and it actually came as good news to the markets, is he didn't say anything new. He maintained maximum policy optionality. And the market liked that because there was some concern that he may go and start talking about this R-star, longer-term issues, which actually are uncertain for markets. So the good news...
R-star, which is this theoretical neutral rate of interest, right?
Correct. What's really interesting is...
Which I want to stop it right here, which again, I think part of, and not this R-star or whatever in the heck they want to talk about there. Again, to me, the bigger issue, was he going to raise the terminal rate? And again, I might be wrong on this, but I think that's the majority of the concern I had going into this, is was he going to pull another Jackson Hole from last year where he just was, and I wouldn't even call it hawkish. I mean, he was downright doomsday last year. And this year, I think he was what most of us were expecting him to be last year.
Is what the two things he did say about the longer term. One is, and we have played it on the air, inflation, the target is and will remain 2%. Very controversial.
Now, I want to stop it here. 2% is not controversial. You may agree or disagree with the 2%. It's not controversial. And the reason it's not is that that's what his goal is. That's what his mandate is for the Fed policy and where he's trying to go. Again, that's not controversial. You may disagree with it, and it may not be what you think it should be. And again, it sure doesn't match historic norms, which is 3.8%, but I wouldn't call it controversial. But hey, we got to use words like that or nobody clicks our views.
And second, that we are operating under the stars, but it's a cloudy sky. These two things are really meaningful because away from him.
And again, I want to stop it here. When was the last time we didn't operate under cloudy skies? Isn't it always a situation where somebody's bringing up some kind of a problem? Either the market's oversold or overbought, in a bear, in a bull, in a bear that's in a bull, I mean, we make up all of this stuff. Again, I'm guessing it's to get people to watch our shows. But why can't it just be the market? It makes absolutely no sense to me that we have to come up with new terms and relate stuff like this all the time.
And unfortunately, there's enough coverage. There was a lot of discussion about how the global economy is changing, how supply-side issues are becoming more important, and what does that mean for monetary policy. So the good news for the markets is they heard what they want to hear, which is nothing new. But the bigger news is that there are real puzzling.
Which, again, I'm going to stop him here because he's just going to go ramble on about this. But he's right. The market heard what they wanted it to hear, which is nothing new. He wasn't bringing up new stuff. Okay. The rest of the stuff he's talking about, again, it's all part of the nothing new. So now there was another gentleman. Now, I normally like Jeremy Siegel a lot, but I think he missed the boat here. So I want to pull up his video and give some opinions on this one.
Our special guest on this Friday, Wharton School professor Jeremy Siegel. He joins us once again. You've been with us on a bunch of Fridays, Professor, which I love because it gives us a chance to sum up what's happened in this stretch ahead of us. And today, of course, it's all about the Fed chair. What'd you make of the speech, first and foremost? And what do you think this market reaction now says about it?
First of all, there was really nothing new that he said in the July FOMC meeting. In fact, I was disappointed because what's happened in the market, as we all know, is that yields have risen, real yields have risen, real growth has risen, And the reason that real growth has risen is because productivity has been so strong. He didn't address any of that. He seems almost stuck in that mode. Real growth is higher. That means more workers. That's more pressure on wages. That means we might have to go higher. And that's not the story. The story is we're getting real growth higher because we're getting productivity higher. In fact, the labor market is slowing down. Expectations for next Friday are what, about 160? Less than half what we had last year.
Okay, I want to stop here for a second. And the problem with what he's saying here with Powell is nothing Powell has talked about or explained or suggested. And what I mean by that is when he started raising rates, what he kept saying was, if we raise interest rates, unemployment should go up. Unemployment should go up, which should cause demand to slow down, which should decrease demand, and we should decrease prices and keep inflation in check. None of which has happened. Which again, that's the normal playbook, the normal scenario, the normal statistics in how things would go under the plan. And he said that from the beginning. And you've all heard me say this in my videos. That's not the case here. And the reason is we're in a different world. And part of the different world is really about the economics behind employment right now. Again, I don't know anyone who wants a job that can't get a job. But not just that, doesn't think that if they do lose their job for some reason, that they can't go get another job making as much money within minutes. Again, you're not going to get this fear with that, but was not due to a normal business cycle. So normal economics, normal statistics are not going to hold. So now I think he's finally getting that. So when he says all this is happening and all this should happen, again, I wouldn't take it with a grain of salt either. Because if the playbook didn't work for everything else, why is it going to work for this? It's the same thing I've been talking about with real estate being 39% of CPI and at 7%, over 7%, you're not getting down to 2. And if you're not getting down to 2, how is he going to get it down to 2? There's only one way to get that part of CPI to get it down to 2%. And it is to raise interest rates to get it up to unemployment, to get at what we talked about. Now the question is, does he push that hard? So this part of the comment, I think Jeremy's missing this scenario because, again, this isn't working the way that the normal models worked in the past. I don't anticipate it working that way in the future until things change or normalize in a normal business cycle, which we're not getting to because COVID's can still becoming a problem and the world is still got this overhang.
Yeah. So in some ways, I don't think he really addressed what the market has been seeing over the last few weeks. That's why I said I think some people got a little bit nervous at the beginning. The market sold off. Now they said, hey, you know what? There's nothing new. We're going to gain back what we worried about yesterday. Market down 300, now up 300.
I got to be honest with you, Professor. I heard, and I don't know, maybe I was hearing the wrong thing. I heard a Fed chair who suggested that maybe the bar is a little higher to actually do more than some others would like to believe. And I say that because of these words, quote, uncertain about the lags, might be significant further drag in the pipeline. He also mentioned the risks of doing too much. That tells me that they're not quite sure what's yet to come, and they're going to be real careful because they don't want to mess it up. They don't want to snatch defeat from the jaws of victory.
And I'm going to get to his comment in a second, but this is exactly what I'm trying to say, is that what Powell was speaking about is the normal delays, the normal, say, shelter should have been showing up by now. We shouldn't be at 7.7% in inflation on CPI for shelter. The lags have not shown up yet. They should show, but they're not there. So what do you do with that? And that's the problem that Powell's got. He knows there's lags. He knows there's stuff coming or should be coming. But all the models aren't working. So if the models aren't working and you're expecting certain things to happen, that means you can't go off of what's gone off previously. So I do think he's trying to be very cautious here because I've said this from the beginning. I thought that we could get inflation down. I thought we could get all this stuff without ruining the economy. And I think it's there. I think he can see it. I don't think he wants to believe it because, again, it shouldn't be that way with all the models, but it is working that way. So let's finish up with Jeremy here.
I think you're right there. And in fact, we detected that as you and I had talked about after the July FOMC meeting. He became much more two-sided. He became much more aware that there are downside risks. I think he heard from 2 or 3 voting FOMC members that are saying, we have done enough. I think he looks at rising delinquencies, and been hearing that on some of the earnings calls. He looks at other, what's happened to mortgage rates at nearly 7.5%. So that he mentioned that little pickup in housing. We don't know how long that's going to last. So I think that is on his mind. How, even though his orientation has been, we may have to do another quarter point. Probably we're going to bypass September. We're going to look at things and see how things are going to be for the November meeting.
Is that the most happening? One more hike, and perhaps that's in the fall. Is there a chance that they are actually? Is there a chance they're actually done?
There's a chance that they're done, and unless the inflation news turns dramatically worse, and the only way we can really do that if the dollar goes way down, which it's been going up, if oil keeps on going up to 100, 110, 120, although they're supposed to ignore food and oil as being more temporary, if commodity prices begin rising, which they really haven't. Now, those have stabilized, to be sure, but we're not seeing the inflation in those components and housing, particularly, that we saw in 2021.
So again, this is where I want to focus on. And what happens in September, again, unless something dramatic happens in inflation and CPI and PPI between now and when Powell speaks in September, I just don't see a raise here. And the reason for that is all the stuff that he was just talking about. And those of you who have seen my charts, we'll go back to them. Here's crude oil. Here's lumber. Here's steel. As he was saying, all the commodities have normalized. And that's what we're looking for. What hasn't come down is real estate. And if real estate can start to roll over, and again, I'm not saying it's going to come down in value. It doesn't need to. It needs to stop going up 7, 8, and 12%. And it should. At some point here, those numbers are going to normalize. And when it does, that's when we're going to be able to get down under 3%. Now, whether we're going to get to 2 or not really depends. If we start having a situation, like he says, where oil starts going up through the roof, I think that's going to have bigger effects, though. And oil is not a huge part of CPI. So I do think oil going up is going to be far more deflationary than inflationary, because I do think it's going to have a bigger effect on everything. It's going to have a bigger effect on real estate and all the other things that haven't really rolled over. And because oil has moderated and people have been able to continue to do what they're doing. In general, I think we've got things going in the right direction. The meeting with Powell was everything I would have hoped it to be. He was aggressive, but not too aggressive. He was hawkish without being too hawkish. He was very focused on making sure we all understand that he still wants to get to 2%, that he's going to still continue to push that. But what I want to really focus on is that everybody seems to think it's a longer term issue, especially this gentleman over here.
I want to tell you what Jerome Powell said today. So this is very important because Jerome Powell is the chair of the Federal Reserve. Powell said at Jackson Hole,
which is a big shock that we didn't know that Jerome Powell was the head of the Fed. Hey, please tell us.
Inflation is too high, and the Federal Reserve is prepared to...
Now, I'm going to stop him here. And I hate it when people say this because, again, they're using a tagline. He said they're prepared if necessary. Do the whole quote if you're going to do it. Don't stop short. Do the whole thing.
So the Federal Reserve and central bankers, they're enjoying their invite-only economic gathering. It's at Jackson Hole. We're talking about the elite class in attendance.
I don't care about this. I don't know why he brings this up.
Central bankers, politicians, the uber wealthy. I'm guessing that you didn't get an invite. I didn't either. So it runs from the 24th to the 26th. And we want to gather clues to see what they're planning on doing at their upcoming meeting.
No, we're not. We have an idea and we already know what's going to happen there, barring something else. But the question was he going to go crazy in this meeting like he did last year and give up a bunch of information or push information that we didn't already have? It's not about what's going to happen up in September.
In September. So I want to tell you what Jerome Powell said, and then I'll tell you what the other Fed presidents said at Jackson Hole. So Jerome Powell says that the target is still 2% inflation, so keep that in mind. So Powell said, and I quote, "Although inflation has moved down from its peak, it remains too high. We are prepared to raise rates further if appropriate and intend to hold at
If appropriate. Don't do stuff like this where you've got quotes around it, because that's not true. There's another part of that, and I hate that.
restrictive levels until we are confident that inflation is moving sustainably down toward our objective." Okay, so I want you to pay attention to this because I want you to understand this absolutely clearly. As Powell mentioned, the rate of inflation has been coming down, but it's not good enough. He wants to see more. Powell said, and I quote, "The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down substantially toward our goal." Powell proceeded to say that he understands that there are risks in doing too much and doing too little. So what he means is that if he doesn't raise interest rates high enough, that inflation can make a comeback. And if he raises interest rates too high, then it can cause unnecessary damage to the economy. And it's not just how high interest rates go, it's also how long that they.
Okay, we're going to stop here because, again, we all know this answer. And we've talked about this over and over again. There's the sweet spot that he's trying to get through. There's the needle he's trying to thread, so to speak, and all the other things you want to say about it. It's not about how long. Because for the decade of the 90s, which went very well, the federal funds rate is where it's at right now. So it's not about this. It's about going higher than that. It's about going to the Volcker time, to the 80s, that concerns people, that we're really going to have to go up to 10, 12, 18%. It's not about whether there's going to be another quarter point here or there. Does he really think he's going to have to raise the federal funds rate so that it has to go up to those 10 and 12 of those higher interest rates? Because the market has not built that in. We're fine where we're at. And what he's basically said is, I understand, which I like this from him, because it's really the first time he's acknowledged the fact that we're getting close to the sweet spot where we need to stop. We need to let what we've done run its course, see what's happening, see what's underlying, see what happens down the road. Are we really going to affect something? Are we going to hurt something? Can we run through this and get where we want to be? And until you run through those numbers, until we actually sit here and go over the next 6 months where he's at, where we're at, whether it's another quarter point, whether it's we're currently at the federal funds rate we're at, we don't know that, but we need to know what the response is going to be. But the fact that he's acknowledged that this is a possibility and that he's looking at that, a year ago, he literally just said he didn't care. At least now he's come out and said, hey, I'm not raising the terminal rate. We might be restrictive enough, and I do understand that if we go too far, we can hurt something over here. We've done this. It hasn't gone too far the other way. Again, I like what happened last week. I'm not saying the market should go crazy over it, but I think this is the best of all worlds from Jackson Hole. That's just my opinion. Talk to your financial advisor. Make sure that your portfolio is where you need it to be so that you can make your goals and objectives. Dickie out.